Markets are shifting, risks are multiplying, and investors are asking, where should money really go? In this edition of Kaleidoscope Dialogues, we explore the answers with Sachin Unamboowe, Assistant Vice President and Head of Sales at Capital Alliance Limited, or CAL. Sachin brings a rich background spanning ecotourism, economic policy, and health tech with a global perspective and financial expertise, making him the perfect voice to decode today's investment landscape. We have a range of investment choices today. How should we begin to identify the right instruments, the right choices, the right sectors? What would these be?
So when it comes to investments, Savithri, I think it's to do with what we want out of an investment, right? And that's how we have to identify where to put our money. So, and this can change depending on our circumstances. As a, say, someone in the younger generation would look at wealth, at building wealth quickly. Someone older might look at preserving wealth. So when we are trying to identify sectors and instruments to invest in, a lot of it has to, first we have to understand why we want to invest. And then we can, depending on the risk, depending on the return we want, then we can identify different sectors and different instruments. So the core is understanding why we are investing and then finding a portfolio to ensure that happens.
So what are the most overlooked opportunities in Sri Lanka right now?
I can name a lot, right? But in Sri Lanka, generally, everyone has very basic principles of investing. They just tend to put their money in FDs, current accounts or savings accounts, or they tend to buy clunky assets like property and vehicles. Now, that is very limiting. There is so many other instruments out there, and you can start with unit trust, there's a stock market, there's government security. So all of these, I would say, are very overlooked by Sri Lankans, right? We are very, very narrow in our investment outlook.
Why aren't people capitalizing on these instruments?
It's a lack of knowledge, right? Because from small days, we've just not been taught this. And what we know and what our parents know and what our grandparents knew was just put your money in the bank. That's the safest thing to do. And there's a reason why we have so many banks for a population of 22 million people, is that a lot of Sri Lankans don't know anything beyond the banking sector. And this is a huge issue actually in Sri Lanka.
If you take, say, your top 3 investment choices, what would they be and why would you say they're your top 3?
Okay. So I'm going to tell you this from a perspective of a 33-year-old, right? So I have a long working career ahead of me and I can afford to be a little bit aggressive with my investment choices. Right now, low interest rate environment, my top choice would be the stock market, right? We've seen the stock market grow by about 100% over the last 2 years. Now compare that to a fixed deposit, which is giving you 8% or whatever it is, right? So that's my number one. Secondly, I would look at these things called unit trust, mutual funds. I'm not too sure whether you're familiar with them, but I tend to use that to manage my liquidity. So there are fixed income unit trusts. A bunch of people in Sri Lanka do this. That gives you a higher return than, say, an FD with also the flexibility of a savings account. So that's my second. Third, given that property prices in dollar terms, haven't increased from pre-crisis to now, if I could afford it, I would look at property as well.
How do you balance short-term gains with long-term wealth creation?
When we look at a portfolio of investments, we need to kind of segregate it into different buckets, right? So chasing short-term gains comes with its own risk. If something is going to appreciate in value by 50% in the next 2 weeks, there's also a chance it can depreciate by the same amount, right? So when I look at my portfolio, I would put maybe 5 to 10% of my total wealth into those kind of opportunities, something that is potentially short-term going to make me a lot of money, but it's also risky. So how to balance these two would be to understand anything short-term which is going to give you a gain is also potentially risky. So you put something that you're willing to lose into that bucket. And long-term wealth creation would be the bulk of your portfolio where you put it into safer, lower yielding but safe assets.
So if you were looking at the stock market, for instance, which sectors would you be buying? There's a vast amount of stuff out there.
Think about it in terms of what we are seeing in the economy, right? Post-Ditwa, we are seeing the government spend a lot of money on construction. So construction is a sector which naturally should do well in the next 2 to 3 quarters. When the government spends money on construction, what happens? It starts trickling down from the contractors to the laborers to the economy. So what do people do when they get paid? They go and consume. 60% of Sri Lanka's GDP is consumption driven. So then I would look at sectors like consumption. Historically, banks and in a time where the economy is growing 4-5%, banks and financial companies tend to do well. So I would look at the banking sector. So there is multiple sectors that we can look at in a growing economy. But for me, the obvious ones are these 2 or 3.
What are the biggest mistakes first-time investors make?
For first-time investors, I have a lot of experience dealing with younger guys who come and ask me about investment advice. Biggest mistake they make, A, not doing their own research, B, following the trend, and C, not understanding that something that is giving you inordinate returns comes with inordinate risk. If every bank is giving a FD at 1 year FD at 8%, but someone is giving it at 15, that means that person is carrying much more risk, right? So understanding that risk to return breakdown or risk to return relationship is a big mistake that people don't make. They see everything giving a higher, they see something giving a higher return and don't understand that it holds more risk.
How can they avoid these pitfalls?
Just by thinking for themselves, right? Not believing everything you see on Twitter or WhatsApp, not following the herd, not trying to catch every share that runs in the stock market. Sit down, it's very simple. All of these asset prices and all are dictated by certain things in the economy. They're dictated by GDP, they're dictated by interest rates. So take a little bit of time to understand this. And right now, in the generation we are in right now, information is available at your fingertips. The excuse of, I didn't know about this is not an excuse anymore. So the one thing the advice I can give people is do your research and understand what you're putting your hard-earned money into. Because if you don't do that, the chance of you getting burnt is much higher.
If a person has is too scared, for instance, to put their money in, also they feel that they just don't have enough knowledge, who do they go to?
Firstly, they should go to a professional fund manager, right? We manage portfolios of funds. So there are instruments called unit trusts, which are professionally managed funds, which even with 100 rupees you can invest into. And these give you, there are different types of unit trusts. You can get something that invests in fixed income, the stock market, whatever, right? So I would go through one of those because then my job is already done for me. I put money into that and that's professionally managed by a fund manager. All I have to do is look at the bigger picture and decide, okay, am I going to expose more to equities now or more to fixed income now? So that comes from me. But the management of the portfolio is professionally done.
So if someone is evaluating a company or a fund, what are the red flags they need to look out for?
If you're evaluating a professionally managed fund, you have to look at the fund's track record. Over the last 5 to 10 years, if the fund has consistently performed, that means it's soundly run, right? So that's one. Second thing to look out for is fund size. Generally, a fund that is doing well and is popular among investors will be a large fund, right? If there is a fund that is 80 billion rupees in size versus a fund that is 5 billion rupees in size, and both are performing at the same level, I would go for the 80 billion because with size comes stability as well, right? When we analyze companies, say on the stock market, for example, what I would look out for is consistent performance, right? If we have a company that is consistently growing, that is consistently keeping their costs in check, consistently expanding their bottom line, and there are plenty of companies like that, well-run companies that are doing well, and Sri Lanka in the last 5 to 10 years has had so many crises. Yet there are companies that have grown through these crises. So those are the ones I would invest in, not something that has done exceptionally well 1 year, made huge losses the next 2-3 years. That is very volatile, right? So I would look at something a bit more stable and more well run, especially for investors who don't know the nuances of these companies and don't know when to time the market.
Speaking of volatility, whether it's geopolitical, technological, environmental, nothing is sort of smooth sailing. How do you recommend investors actually prepare for volatility?
It's a difficult question, right? But again, it comes down, we are living in a period of intense volatility, politically, environmentally, geopolitically, like you said. So it comes down again to crafting a portfolio that you can put away a certain percentage of portfolio that we know that there are assets that are immune to volatility or that do well in volatility. Gold is one of them, right? When you see political risk, gold tends to do well. Hard assets tend to do well. In Sri Lanka in 2022, we had our biggest economic crisis ever. And the rupee depreciated by 60%. But if you had bought hard assets or bought gold or bought dollars even, right, you would have shielded yourself from that. So when we know that there is volatility on the horizon or that we're going through volatility, you can increase the percentage of your investments that you put into something that you know is an anchor against volatility. So that is how we think of a portfolio.
What realistic benchmarks should investors set for returns? How do they measure it, for instance?
At the end of the day, if you want to grow your wealth, right, you need to beat inflation. So that is the first benchmark. If you are investing in something that is not beating inflation, essentially your money is reducing year by year. So the first benchmark to beat is that. Then secondly, depending on the amount of risk you want to take on board, you can then start saying, okay, I want to beat inflation by 5%, 10%, 15%, whatever. But the most common benchmark is you need to beat inflation. And this is after tax, not before tax. So after tax, you should be beating inflation. That is the benchmark.
Would you have any examples of investments that actually looked very promising and then underperformed, and what lessons were learned at that point?
Many of them. The first thing that comes to my mind is, at Cal, we've done IPOs. We did one in 2021 for a big apparel firm that has lost 75% of its value to today, right? So that was a big, a huge erosion of wealth there. Lessons learned were, again, be more mindful. At the time that company came to market, it was actually doing fairly well. The biggest lesson is then to track that company's performance over every quarter and make sure, hey, these are all publicly listed companies. You can analyze how they're doing. So you need to kind of really make sure that whatever you invested in, that you keep an eye on their financials, especially in equities, and you make sure that they're not going off course. And if you think they are going off course, you sell out of that investment.
If someone has limited capital, what is the smartest way to diversify without actually diluting potential returns?
A unit trust. I would go into a unit trust or a mutual fund, same thing. There even if you have 100 rupees, like I said, if you put your 100 rupees into an 80 billion rupee fund, you have all the diversification and all the leverage that fund has, even though you have only 100 rupees in there. So for anyone with limited capital looking for a diversified portfolio, it's a no-brainer to go into a unit trust.
How can people manage to stay informed without being misled by hype? Because there's so much information out there. It's an information overload.
Absolutely.
How do they work that out?
They need to just figure out what the sources are that they're looking at, right? There's plenty of WhatsApp groups and Twitter posts and all which mislead people or which are overhyped. But if you stick to the traditional sources of where you're getting your news from, you read the paper every day, all these companies or funds that people invest in, they have to report their financials on a monthly or a quarterly basis. In the case of unit trust, it's monthly. In the case of listed companies, it's quarterly. That is, that's not hype, right? That is actual raw information. So, be very careful of where you're getting your information from. There's a lot of fake news out there. Don't follow the herd, like I said earlier. Don't just because everyone is buying some share, don't just blindly go and buy it. Maybe try to understand why, and then you can decide yes or no. And make sure that whatever you invest in, you really understand why you're investing in it, really. That's the bottom line.
Stay connected with Kaleidoscope on YouTube, Facebook, Instagram, and LinkedIn to catch all our latest stories.
You focus on your goals. We will take care of the risks. Silingo Life.